Hi everyone, so what I want to show you here is, let's say we've got an investment, okay, and on the y-axis we've got time. Alright, so this is day 0 and this is going to be sort of end of 12 months. Okay, so we've got the month ending there. Now, very simply, let's say on day 1 you buy a stock. Maybe it's $1,000 worth of whichever company, doesn't matter which. Well, that's very simple. If it's a performance company, we're going to hold it for 12 months. We see what happens. Hopefully it's gone up, it's worth whatever, it's worth 1,100, let's say, or possibly it might have gone down, it's only worth $900. That's all very simple. We know to exit. Maybe during that period it fell somewhat, it hit our stop loss, and our stop loss might be 25% of the value, so it got to about $750, let's say around June time, in which case we'll have exited, okay, around that period. All very straightforward, all very easy. However, now let's look at the scenario, same situation, 12 months, today is month 0. Now what do we do? If instead today, again, $1,000, okay, but instead we decided, because we're somewhat risk averse, that we wanted to pound cost average, and or dollar cost average in this case, and we decided that 1 month, 2 months, and let's write all these down all the way up to 11 months, we were going to, out of our portfolio, put equal sums in on our dollar cost averaging of $1,000 a month into this particular company. And let's just, for argument's sake, assume that it's Microsoft. Okay, so the issue then arises, we're going to buy $1,000 on each month of that stock, and of course at the end of 12 months we'd have $12,000 worth, and that's our allocation for this particular stock. All very straightforward. However, let's say it's 3 months in, and let's say for the first 3 months the price has just been flat, but all of a sudden on the 3rd month, let's say the price of Microsoft has suddenly increased. So the share no longer trades at, let's say, $100 is where it started, but all of a sudden it's trading at $150. What do we do then? Do we still buy $1,000 worth of stock at $150 a stock? Well, we're pound cost averaging, so actually, yes, indeed, that is what we are supposed to do. Okay, now you might say, well, actually, Alpesh, what if I change my mind? Well, we'll come to that separately, but we are supposed to buy it. Equally, what if it's dropped from $100, let's say, to $80? Okay, so it hasn't hit a stop loss. We don't need to exit everything or anything, but it's at $80. Well, again, we're supposed to dollar cost average, and we buy $1,000 worth of stock at $80 a share. We'll have picked up more shares than if it was at $150 a share, obviously, because it's cheaper. So for our $1,000, we'll buy more shares and we'll earn more shares, and that's fine. And that's what we're supposed to do. So that's all very straightforward. But the question then arises by some people is, hang on, do I treat this as a separate purchase and start the clock running from this time where t equals 0, and then we go 1 month for this holding? And the answer very simply is no. 12 months is 12 months, and so this holding and this holding and this holding, all of them are exited, or rather they're reanalyzed at the end of 12 months from the first holding. That keeps life very simple. It also avoids all the complexities of having multiple holdings and very complicated spreadsheets of each month having a 12-month period for each separate holding. That would be very messy indeed. Okay, so that's a very simple scenario over there, what you're supposed to do, how you're supposed to hold it, and for what duration and time frame. Okay, so that's perfectly simple and straightforward. However, let's look at another scenario. Okay, so we will start again. We've got our timeline, that's 12 months. This is today, it's 0, and we're still looking at, let's say, Microsoft for argument's sake. And don't assume Microsoft's a quality company, just assume it's any old company, okay? Just a normal, regular company, and its share price is $100 a share on day 0, which is today. Let's say, for argument's sake, this stock drops and hits our stop loss, which was at, say, $75. Got it? Okay, so now we've exited and we've got some money left, right? And people say to me, what do I do with that? Do I just hold cash for the rest of the year? Okay, or should I reinvest that? Now, there's two options. First of all, if you hold cash for the rest of the year, then you definitely know that the most you could have lost on, let's say you started with $1,000 for this share, and it's now, of course, gone down to $750, okay? Because the share price dropped from 100 down to 75, so you're left with $750. So you know that the most you could lose over 12 months in your Microsoft holding would be $250. Okay, that's the most you could lose, and that's what you know for the next until the end of the 12 months. So that gives you a degree of certainty. Now, imagine instead at this point, when the share price drops there, you decide, well, I'm going to reinvest that, Alpesh. I'm now going to put that $750 that I have left into a brand new company. And I will hold that from month, let's say that was month 3. Okay, I'm going to hold that from month 3, and that's $750 for the next 12 months from then. Okay, so it'll be these 12 months plus another 3 months, because this was already 3 months gone. You can see how it starts getting complicated. And the danger with that is, let's say markets are very volatile and that new holding drops another 25%. On that basis, if you kept doing this, you potentially, from this original Microsoft holding to whatever the new thing you might have transferred into, let's say Adobe, and that then dropped 25%, and then you moved into something else, you potentially stand to have an unlimited loss. So you would not know on day one, when you started out all this on day one, how much you might end up losing by the 12th month. Whereas if you stuck to the first holding and had your stop loss, you know the most you could ever lose is that stop loss on any one holding, which is 25%. So the choice is yours. If you're more risk loving, then you'll keep reinvesting, but that will be complex because you've now got to keep a tally, not of that 12-month period, but each period thereafter for each new holding. Okay. If you're risk averse and want to keep life simple, you just keep holding in cash. I know what you're thinking. Alpesh, if I'm holding cash, aren't I missing out? Yes, you are, but it all depends on your level of risk aversion, and it also depends upon the level of simplicity you're looking for. Now, personally, I'm a geek. I tend to reinvest, all right? But the simple rule is that you don't have to, and at least you'll have some degree of certainty. So that's the trade-off in that scenario. Okay, hopefully all very simple. And in case you need to see all those ugly images all over again, there they are in one slide. That was the first set, that's the second set, and there you go, the third set of all of those. Hopefully all very useful for you.